Welcome to Things Uncovered. Today, we're making the stock market easy to understand. So let's get started.
This is Rahul. His tea shop, Chai & Company, is a local hit. Every morning there is a line around the block because his tea is just that good. Rahul wants to take this success further. He dreams of opening a Chai & Company in every city across the country. But building dozens of new shops and hiring hundreds of people takes a massive amount of money, way more than he has in his register. He could ask a bank for a loan, but that is a heavy burden. For a single business owner, borrowing that much money is expensive and carries a lot of personal risk. If the new shops take a while to get popular, the interest on that loan could shut him down. Instead, he considers a different path. What if he breaks that massive total cost into thousands of tiny, affordable pieces? He can then invite regular people to contribute a small amount of money to help him grow. By doing this, Rahul doesn't have to carry the debt alone. In exchange for their help, his supporters get a share of the profits as the business expands. It's a trade that lets a small business dream much bigger. Merchants 400 years ago used this exact same logic. Building a fleet of ships for trade was far too expensive for one person. To get those ships into the water, they needed to find a way to share the cost. They solved this by dividing the price of a voyage into shares. This allowed everyday people, from tailors to farmers, to pool their savings and fund the construction of a ship. To keep track of who helped, the merchants issued these ornate paper certificates. This was the physical proof that you owned a piece of the voyage and were entitled to a portion of whatever riches the ship brought back. By 1875, this concept arrived in Mumbai. Local traders began gathering under a banyan tree to buy and sell these pieces of ownership. This informal meeting place grew into a structured market, becoming the first official stock exchange in Asia. These markets were built to act as a link. They take the savings of thousands of people and put them to work, helping builders like Rahul reach their goals, while giving the public a way to participate in that growth. Back at Chai & Company, Rahul is ready. To open his business to the public, he launches an initial public offering, or an IPO. This is the formal process of turning his private shop into a public company. This diagram shows the math involved. The large circle represents the total value of Rahul's company. For the IPO, that value is sliced into thousands of digital units called shares. This makes it so anyone can afford a small piece. Once these shares are created, Rahul needs a secure, regulated place to offer them. He can't just sell them over the counter. He needs a marketplace that ensures every trade is fair and recorded. Today, those markets are digital. Rahul lists his company on the National Stock Exchange. The banyan trees have been replaced by high-speed computer networks that allow people across the country to find and buy his shares instantly. An IPO is simply the moment a business steps out from being a private venture and becomes a project that anyone can help build. Meet Priya. She's a regular at Rahul's shop and wants to buy a digital slice of the business using her phone. To do this, she needs a trading account. Think of this as her connection to the exchange. When she taps Buy on her phone, this account sends her order directly to the NSE to be matched with a seller. She will also need a DMAT account. Since we don't use paper certificates anymore, the DMAT account is like a secure digital vault. Its only job is to hold her shares safely after she buys them. This flowchart shows the path her money and shares take. Her order moves through the trading account to the exchange. Once confirmed, the share is routed back and deposited into her vault. This whole loop completes in a fraction of a second. What used to require physical crowds in the street is now a simple, secure action anyone can take from their living room. Once Priya owns her share of Chai & Company, she'll see the price move up and down. Some days it's higher, some days it's lower. This happens because of two simple forces, demand and supply. If Rahul's new shops are full of customers, more people will want to buy shares, which pushes the price up. But if costs for tea leaves go up, some people might want to sell, which brings the price down. You'll hear these moods described with animals. When people are feeling positive and prices are rising, it's called a bull market. When people are worried and prices are falling, it's a bear market. Because prices will always fluctuate, Priya uses a strategy called risk management. The most important rule is to never put all your savings into just one company. This pie chart shows how to stay safe. Instead of owning only T shares, Priya buys small slices of companies in other fields, like technology or transportation. This way, if the tea business has a slow year, her other investments can help balance things out. The stock market works best as a long-term partnership. It's a way for anyone to support a neighbor's ambition or a new idea and own a small piece of the businesses that build our world.
Thank you for watching this video. I hope you enjoyed it. Please do like and subscribe. It'll motivate me more to create more informative videos every week.